Jimmy, how are you doing? It's 2026.
Jeremy, I am wonderful, thanks. Glad to be back. How
It's
are
good.
you?
I'm doing great, man. I got to be honest. It's nice to see the new year, but we want to do a real quick look back on 2025. It's not too far out of our minds, right?
Not
So
yet.
let's take a look and see how the performance was in the markets.
Sounds good.
So first and foremost, we'll take on the stock indices here. So the ones we're looking at are the S&P 500, Dow Jones Industrial Average, the Nasdaq, and then we've got international stocks from both the developed side of the world and the emerging side of the world.
Right.
So yeah, lots going on here. Thematically, what are you seeing?
So, I think it's an interesting year to look at. Obviously, if you're looking at the chart, you start on the left side and you work your way throughout the course of the year, moving to the right. It was a kind of a scary time there for a little bit in early April when the tariffs were announced and the markets did not receive them well at all. As you can see, quite the
No doubt.
dive across the board, right?
Stressful time.
International stocks, emerging market, all the U.S. stocks, it was under pressure. But after that, the market sort of seemed to digest that. There were changes made, and then it was sort of off to the races. But at the end of the day, I think it is important to note that the international stocks outperformed the U.S. stocks, and by a pretty good amount.
That's got to be the big takeaway when you look at a 12-month span on it because they did fantastically. 30%, 20, not 8% between the two of them. This used to work in cycles.
Right.
Classically about a 7-year cycle.
Right.
Where international would be better off for 7 years and then U.S. would be better off for 7 years. And we've certainly, the U.S. has definitely overstayed on the positive side of that
Right.
ledger.
Absolutely.
But here we are. International did really well. And to your point, I just want to go back to it. April. Yeah, I mean, it's really interesting to look at it now and just see, oh, it looks like a blip on the radar screen. But you know what? There was a lot of prognosticators, a lot of smart people who were quite worried
Right.
during the middle of that.
Yeah. And look, this is a review of the market, so I don't want to get too deep into financial planning, but this does really tug on the importance of financial planning. Like when we build plans, we account for these big drawdowns that can and will happen, right? And if you had a plan, I think it gave you the confidence to live through that very volatile moment and not make any really bad decision.
Because once again, right, if you had freaked out and you had gotten out of the market, tell me when you were going to get back in and
Right.
take advantage of what the market continued to do for the rest of the year.
It's really difficult to,
It's
right?
a very risky endeavor. So here we are. Great year in
Yeah.
retrospect.
Absolutely.
Drilling in a little bit further, the Magnificent Seven. A lot of our listeners hear us talk about the Mag 7. It's Alphabet, meaning Google, Apple, Amazon, Nvidia, Microsoft, Meta or Facebook, and Tesla.
Yep.
Here we are. Here's how they performed because the sort of the theme or the knock in some respects on the Mag 7 was, look, they're driving the market. If without them, the market isn't going to do very well.
Right.
That has been sort of a refrain. 25 sort of departed from that.
Yeah, which was refreshing, I would say. And look, obviously, there's so much of these companies are tied up into the whole AI theme, right? And we've talked about that in other videos that we've done, the importance of AI. And what jumps out to me here are a couple things. One, just the amount of volatility within individual names, right? I mean, there was enough volatility looking at the indices overall as the S&P 500. The Nasdaq and the Dow, there was enough volatility in those indices that have far more than just one stock in them.
Yep.
But when you're looking here and you track you pick any of the colors, there's quite a bit of movements in these individual names. But I think, to the point you were making before about a little bit of a divergence from the Magnificent Seven driving the return of the broader indices, this year only two of the seven actually outperformed the S&P 500, and that was Nvidia and Alphabet, which is we know is Google. So interesting that the Magnificent Seven, only two of them outperformed, And Google was quite the story that it really took shape later in the year too.
Mm.
And I think for quite some time within the whole AI theme, Google was, there were some thoughts of maybe they're not really well positioned to take advantage of AI, and then that proved to not be the case. It ended up being the top performer of the Magnificent Seven. So my two big takeaways are the amount of volatility in each of the individual names, and then only two of the seven actually outperforming the broader based indices.
I love those takeaways, and what you said about Alphabet or Google, I think is really important for us to note, because even though we think this company might be getting kind of old and crusty, even though they're clearly in the tech space, but in fact, innovation is constant. It's these companies are really, really good at what they do, and they're constantly looking for the new advantage, the new edge to continue to keep themselves on top of the mountain. Google did just that. They didn't have a great 2024.
Right.
Even like to your point, the first half, more than half, or the year
Yeah.
was like sort of underwhelming. But then look, they had some announcements,
Yeah.
showed that they're really in the game. Here
Right.
we are. Google killed it at 65% return.
Yeah. Very impressive.
And then lastly, the asset allocations. So this is where you've got some of your assets in stocks, some of your assets in bonds. This is where a lot of clients find themselves in some variant of this.
Right.
So this runs the gamut from 100% in stocks all the way to 0% in stocks and 100% in fixed income.
Right, exactly. So what jumps out at me here, look, what this shows you is that it was a really good year for capital markets across the board.
Mm-hmm.
Right? We focus on the stock indices to start, but now if you look at the bottom bar here, the worst performer, if you want to say it that way, the all fixed income, which is in theory the safety net to the portfolio. You still had a return of almost 8% for the year in
Right.
fixed income, which was
Amazing.
really good, right?
Really great.
Now,
Yeah.
it shouldn't come as a great surprise, because if you remember back to 2022 when we had all those interest rate hikes, that was here to combat the inflation from COVID and the pandemic and all the spending that went on there. We sort of reset the fixed income markets, right? It was painful in 22 because of the interest rate increases. But now I don't know if you really call this like a rate cutting cycle, but we've certainly been cutting rates for the last couple of years, which is very beneficial for bonds and the prices of them, the inverse relationship. So look, there's a spread there between all stocks and all bonds, but it's not that large of a spread. And so I think risk adjusted returns this year were it was nice to see the asset allocation doing very well.
It was a good year to be invested,
Right?
Let's just say it that simply. But you're right in all the fundamental ways. You're right. A lot of people can't go all in on one direction. They shouldn't go all in on one direction.
Right.
There's a right fit for everybody. There's a different story for everybody, and that's kind of what the asset allocations are telling us.
That's right.
Well, that's all we have here. So we look forward to the rest of the year, 2026. We've got a lot of things coming out from two fiduciaries. So be on the lookout.
That's right. 2026, here we come.